Does that mean you put all your money in there? No, it only really works if you utilize it in concert with all the other tax-free streams of income. The money in the LIRP, the growth of the money in the LIRP is governed by a completely different section of the IRS tax code. What does that section of the IRS tax code say? It says you can touch the money pre-59.5 without penalty. You can't do that in your IRA or 401k. They're going to tell you that as your money grows, you receive no 1099s. What does that mean? That means no taxes as your money grows, like you might experience in, say, a brokerage account. They're going to tell you that when you take the money out, if you take it out the right way, it does not show up as reportable income on your tax return. That means it's tax-free and does not count as provisional income, does not count against the threshold which costs Social Security taxation. They're going to tell you that there are no contribution limits. Remember, with the Roth IRA or Roth 401k, Roth 401k this year, you've got, you can contribute $23,500 plus another $7,500 catch-up. And there's some higher amounts if you're within, I believe it's 64
or something like that.
64, something like that. You can go a little bit higher. I got clients that put in $50 a month, and I got clients that do $200,000 per year into the LIRP and everywhere in between. There's no income limitations. I often ask the question, can Bill Gates do a Roth IRA? And the answer is, of course, no. Why? He makes too much money. You start making north of $246,000 of modified adjusted gross income, you can no longer do a Roth IRA. And I also joke, can my kids do a Roth IRA? And the answer is always, to do a Roth IRA, you have to have earned income. And I always like to jest, my kids work, I just don't pay them, right? So you got to have earned income to do a Roth IRA. And then the last one that I like to talk about, one of the benefits of the LIRP, is this idea of legislative risk. It doesn't appear to have legislative risk. What does that mean? A lot of people think that means they're not going to change the rules on it somewhere down the road. Well, guess what? They did change the rules on this thing 3 different times, in 82, 84, and 88. But every single time they changed the rules, they simply said whoever has the bucket before the rule changes gets to keep it and continue to put money into it under the old rule for the rest of their lives. You call that a grandfather clause. And so, that a lot of people like all of those different benefits because they can do some things that not all of the other tax-free streams of income can do. Does that mean you put all your money in there? No, it only really works if you utilize it in concert with all the other tax-free streams of income. We talked about it, but it can be part of the puzzle. And one of the things that experts like you do is you help people understand how all of these puzzle pieces fit together in such a way that they can get to the 0% tax bracket and be truly shielded from the impact of higher taxes.
One of the things I love about that is the tax-free loans that come out. That's how you do it. You're able to take tax-free loans from the cash value. Speak a little bit to that.
Sure. So basically what's happening here is when you take that loan, you're not taking a loan from your own cash value, but you're using your cash value as collateral against a loan that the insurance company has given you. And the way it all works out is it ends up being a tax-free and cost-free distribution. So let me sort of explain that. So anytime you take a loan, whether it's from a life insurance company, a mortgage company, your rich Uncle Louie, it doesn't show up as taxable income on your tax return because the IRS assumes you will be paying that loan back with income that has been taxed. So they're going to get you somewhere along the line. And so when an insurance company gives you a loan, in order for it to be an arm's length transaction, they have to charge you a stated rate of interest. Let's call it 3%. So they charge you 3%. And that's the money. Let's say you requested a loan of $100,000. That's what you get in the mail the next day or 5 business days later or what have you. In the meantime, what they've done is they've taken $100,000 out of your cash value and put it in what I call a loan collateral account. Okay. So, and what they do is they credit that loan collateral account a stated rate of interest. Okay. So remember, they're charging you 3% over on your loan, but they've taken money out of your cash value, put it in a loan collateral account where they're charging you a rate of interest. They're crediting you a rate of interest. We'll call that 3%. Now, there's certain carriers out there that will guarantee that what they charge you and what they credit you will always be the same number. So they'll charge you 3, or they'll charge you 3, and then they'll credit 3 right back to you. Yeah. So all you know is that you asked for $100,000, you got $100,000, your cash value went down by $100,000, and there was no net cost for doing so. Because it was a loan, it was tax-free. And because they credited right back to you the cost of the loan, there was no net cost associated with the transaction. So it's a tax-free and a cost-free distribution. So on paper, it feels as if it were a distribution from a Roth IRA because you didn't have to pay any tax along the way. So this is how, you talk about, I think it's who was the coach out of Michigan? Was it? It's either John or Jim Harbaugh. I think it was John Harbaugh.
Yeah.
One of the Harbaugh brothers had one of these programs as part of their compensation package. They were getting something on the order of $1 million per year of tax-free, cost-free loans out of a life insurance policy. And, it was one of the benefits that they gave him to try to get him to stick around. He didn't stick around, but it was one of the inducements that they gave him to stick around, because tax-free, cost-free distributions every year of your retirement to the tune of $1 million, it's a pretty nice benefit.